right, we're live. We got the live streams going on out there. We got Christmas around the corner. It's less than 24 hours away. I think we're all excited about getting cocoa. Some of us got snow. Some of us did not. We got a couple. Is who bam? What's up, order? Bam bam. So today, this will be a pretty beginner-friendly introduction to the stock market. I'm looking for one specific person to be able to join. I don't know if he might be working or in class. But this will be recorded for him either way. So hopefully he's able to show up. Otherwise, we're good to go. So I want to start with what the stock market actually is first. So first we have companies, then we have shares, then we have exchanges, right? Then we have brokers. Then we have orders, right? That's how we participate. I guess I'm trying to think of a logical way to break this all down. And if anyone has any questions along the way, feel free to ask. I am more than happy to keep this pretty beginner friendly. Then we've got the portfolio, right? That's where we have our pool of stuff. Actually, I'm going to put that above here. And then we have, let's see, we've got strategies, right? And then we've got trajectory, right? We've got a growth trajectory. And then we've got, within here, we've got, let me see, we've got portfolio structuring, right? Which is something most people just overlook. Then we've got position structuring. And then we've got, within that, we've got technical analysis. And above that, we've got fundamental analysis. All right, so this is kind of the checklist, just to build a basic plan. So first, let's start with companies. Companies are pretty simple. They're just like you and I. They have a budget, they have inflow, they have outflow, meaning they make money, they spend money, they got to pay for property, taxes, inventory, labor. They pay all this stuff. We also pay for stuff. We pay rent, we pay taxes. Everyone pays taxes. We pay for Netflix, we pay for cell phones, internet service, utilities, all this stuff. Some people have more than one form of income. Some people have many. That could be a side business. It could be doing Grubhub maybe on the side, or maybe you get child support, or maybe there's some sort of annuity payment you're entitled to. It doesn't really matter. And money in the market counts as an inflow, but it also carries an outflow along with it in the form of taxes. Hey, what's going on, sad boy? Good seeing you, buddy. You are an X. I should probably keep that open as well so I can see all the comments. So feel free to tune in, though. Hang out as long as you can. But basically, I want to just point out that a company has a budget. We have a budget. We are not that much different in terms of how the market operates. So when a company gets big enough, it can offer pieces of itself to the market for investor money, right? There's the company over here, and then there's a bunch of investors over here with a ton of money. They want to give the money to the company. The company needs to give something back. So they just chop up little pieces of the company, and those are shares. And then there's different types of shares. I'm not going to get into all that stuff because, again, I want to keep this pretty beginner friendly. But just know that the company is offering portions of itself, and that comes with certain things like voting rights. So if somebody buys enough of these shares, they can participate in the votes. And that kind of makes decisions about how the company operates, whether or not the CEO gets a raise, things like that. And then they also have different types of shares. So you can also get things like dividend entitlements. You get priority on dividends. So a company wants to pay their shareholders a little bit extra. These people will get their piece of the pie first, just in case there's not enough to go around, for example. So shares are important. Mostly, though, we don't care about that too much if we're just speculating or just buying to hold shares. Most of the people in the market are not going to be looking to invest to influence company decisions or anything like that. So we just buy our little piece, and we pay a cost, right? It costs money to buy those shares. And our hope is to hold those shares until they increase in value and that someone else is willing to pay more for them. So then we sell them. And sometimes people are willing to pay less. The value goes down. It's just supply and demand, right? So we'll get into all that later. But in order for the companies and the shareholders to connect, I suppose I should be sharing this this list as well, because I didn't realize that was my face the whole time. My bad. All right, can you guys see that okay? It's a text file. I'm sitting here going down this list here with my keyboard, and it wasn't showing up for you guys. So my bad. All right, so we're on this one right here. So we got companies. We understand what those are. We understand what shares are, generally speaking. It's a very simplified explanation. It gets very complicated if you want it to. In order for companies and investors to connect, there needs to be some place for those to exchange, right? The money and the shares have to change hands somehow. So the exchanges were established, and exchanges are 1,000+ years old. It's nothing new. The newer versions of them online, of course, are in the last few decades to the last century. So just keeping that in mind, that exchanges as a concept are pretty old. But this is basically just a collection. It's like an auction house where brokers, which I'll explain in a second, are able to go there and place these bids and buy things. It's like a big online store, and your broker's job. I'll explain what a broker is. So a broker basically is someone who's authorized to act on your behalf in this store. They have a membership. They can walk in, they can buy stuff, they can leave the store without getting frisked. Think of them like a realtor mixed with like a lawyer. Like they're a banker, lawyer, realtor kind of person, right? There's many different types of brokers. For the sake of keeping this super simple, they're the person. They're like your lawyer. They're going to go to the exchange and buy these shares for you. Yeah, just like Austin. Because you can't call up a company. Well, I mean, you could. I can't really say that, but you typically wouldn't call a company up and say, "Hey, I want to buy 5 shares of the stock. I have money. Where do I send it?" Right? Because the company's gonna be like, "You got to go through the market, buddy." And that's what brokers do. They handle all the liability. They handle all the technical aspects of the transaction, so you don't have to worry about that stuff, because it is going to be a lot easier and a lot more profitable long term if you just use a broker than if you try to do it manually. Plus, you're not licensed, so you can't really interface in certain ways because the SEC won't accept your filings. So it's, again, I'm trying to keep it super simple, but just understand that a broker is kind of the human element or the digital element for you to be able to participate so that you can buy these shares and so that the company can also get access to your money, because that's important to them. And you do that through an exchange. There's different exchanges. They all have different rules for what companies need to do in order to be listed, to be available in their store. Just like, think of it like Walmart. Like you can't sell T-shirts at Walmart that have like the middle finger on them. You're going to get in trouble. They're not going to accept your T-shirt and they're not going to sell it. So you can't be part of that store or that exchange if you have something that doesn't meet the criteria. If it's a really cheap quality product too, they might just deny it. Not Walmart, because Walmart sells trash, but Walmart CEO, if you're here, that's a joke. But that's the idea. Think of them like auction stores, basically. And the shelves are just lined with different companies that do meet a minimum criteria. Okay. And then there's you, right? So you need to basically set up some sort of pool or some sort of account so that your broker knows where to pull the money from and where to keep the shares. So it's like a bank account. Think of it like that. So we call those portfolios, and a portfolio is just it's a special type of account where different types of instruments can be deposited, meaning your money can be deposited, shares can be, equity shares can be deposited, the various types, options contracts, bonds, warrants, futures contracts, all this stuff. It can all go into the same pool, basically, assuming that your broker offers that. Sometimes you have to open a different account. And that's where you participate. Like that's where you interface with your broker. So you've got this little chain of communication here. You've got the company, and then you, and then both of you guys go through broker. You go put your stuff in a portfolio, and you give instructions to the broker through the portfolio through orders, which I'll get to in a minute. Your broker then takes those and tries to implement them on the exchange, and then that results in a transaction, right? And then you basically just flip this backwards, right? That transaction, once it's met and filled, equal and opposite, someone has to buy, someone has to sell. It goes through the exchange. It's printed on the exchange. Then the broker sees it. Then they know that they have the shares. They complete the order on their end. They know that it's filled. They can let you know. And then those shares or cash goes back in your portfolio. And then you have access to that. So you can place further orders or take the money out when it settles or anything else you want to do. So that's the general structure of the communication from top to bottom in the market. Does that make sense so far? Like if this doesn't make sense so far, I'm happy to slow down. I'm trying to keep it simple, but I know that I ramble a lot and I go super, super deep sometimes. I actually want to talk about decoherence here later on, but we'll get to it. So if that makes sense, I'll continue. Otherwise, just let me know and I'll slow down and focus on whichever piece of that might not have landed well. So then we get to the orders part. The orders is pretty straightforward. That's just like writing a check. Like a check is just a little form that you fill out that tells the bank to transfer money from this account to that account. That's all an order is. It's just saying, take something out of this portfolio, do it a certain way on the exchange, and then put it back in this portfolio, and then just make that transaction between these two different types of, two different parties, right? The company and me. and then the broker does that for you, basically. So think of this just like a preference form, like you're filling out different fields, like what price are you willing to pay, right? If you're not willing to pay more than a certain price and it's a certain order type, like a limit order, specifically a limit buy order, which I can jump into specific examples in a little while, but if it's a limit buy order, that will get filled at that price or better, meaning lower, because your broker's job is to try to get you a better deal. So he's going to try to get a lower price if possible, he or she. If it's a market order, for example, you're just wanting to get in, you'll pay whatever you can get. It's just a best fill order. So the best available price is what you get. But you guarantee that you get filled unless it's halted and then you get other stuff going on. But so the order type matters. It's not just something that we don't want to gloss over that. Same with sell orders, right? And then we kind of get into the more strategic stuff. So this is kind of the how-to, like how things work. This is just the 6 layers of mechanics. And then we get into the thinking part, which is, how do we impose our will in the market? How do we make money in the market? How do we have deliberate control of stuff? Not just, okay, I know I can place an order. I know I have a portfolio. I know what a broker is. I know what exchange is. I want to put these together and I want to start making money, right? So we got to kind of dive a little bit deeper into the strategy stuff, because this is where people tend to get messy, right? And I want to tell you right now, technical analysis and the market in general should have a very small piece of your attention. It shouldn't be all you do. The market is not a lifestyle, and I kind of should have started off with this. It is a small glorified side hustle. It's like a savings account where you control the interest rate, and that side hustle will eventually impact your lifestyle. It shouldn't be the other way around. If you make this a lifestyle that you need to then go out and make another side hustle to try to pay for, you're going to have a hard time. So the first thing we can do, the best thing we can do, in my opinion, is just slow down. Keep the expectations realistic, keep things small, and shift your goal of success early on, not just to making money and chasing profits, but to being successful and consistent. When you have the consistency, the profits will work themselves out, right? As long as everything you do makes that the probable outcome, that should happen more often than not. If not, that's a matter of just fine-tuning, collecting data, and all that good stuff. So there's a whole journey here that we have to consider, not just technical analysis. Now, that is used for identifying your risk ranges, and it can be used to optimize profits, but it's not a prediction tool. And that's where people jack themselves up in the market, because they try to predict stuff. And trust me, you don't want to do that. It doesn't work. So the first thing we got to consider is the hierarchy of risk. And that's all this is. So if we're considering the portfolio, right, we know that we've got all these little types of things that can go into it. It's a magic bag that can accept all different types of stuff. We know one of them is cash. The other one is common shares, or Class A, or even preferred shares, depending on the type of portfolio. But you got cash and shares, right? We'll skip to options for now. We'll do that later. Your portfolio should have a structure to it in which everything you buy and everything you sell should occupy a role or a slot. This portfolio is your company, if you think about it like that. Every company has departments, or should have departments, once they reach a certain size. And most portfolios never really make it out of that startup mentality, because it's like every dollar is trying to do everything, and we just grab whatever's available and try to find the talent. And that's chaotic. So instead of doing all that, we can put a structure in place so that we're not spastic, because we don't want stress. We don't want chaos. So what does that mean? That means that I should have some allocation of something stable. I should have some exposure to something that is going to grow on its own. And then I can have a smaller piece if I want to try to speed that up, right? I don't want those the other way around, especially if I can't prove to myself with data that I'm able to actually grow it. I kind of want to let the tried and true stuff take over first. So if, as a new trader, I can't outperform 2% a year, that money that I would normally risk to the market probably is going to do better off in a bank account, right? I don't need to put any real money into the market to learn how to do this. That's a lie we tell ourselves. It's a lie we see all over social media. You don't need to risk real money to learn how to do this. I don't care what anybody says. There is an element of psychological resilience when it comes to managing real losses, but we can develop the entire foundation around that and even practice a good chunk of that without risking a penny. Okay. So I don't want anyone to feel like they have to just start an account and dump a bunch of money in and hope they figure it out before they run out of money. What I would rather see is protect the money. Like, just, I can't legally tell you what to do, but I'd rather see people do that instead, because then you're not chasing profits, right? If you feel like you need to trade and you feel like you need to have real risk to learn how to do this, you are chasing. That's a FOMO. It's a form of fear of missing out. So with that in mind, once we figured out a safe place to stash our cash, we can practice. We can collect data. We can use simulated accounts. We can use literal piece of paper and a pen, and we can just collect data. Now, the trade data is going to be separate from your psychological data. And what you really want to focus on is the psychological stuff, because the trade data is very simple. I can pull up a broker right now. This is my small cash account right here. I can say, I want to grab this guy right here at this price point, and I'm willing to sell it if it drops below here, and I'm willing to sell it for a profit if it hits this one here. It's going to hit these levels one way or another. That's objectively true, right? So if my plan is to buy it here, sell it here for a loss, sell it here for a profit, every time it does that, right, I'll have a finite set of data at the end, because it's going to hit this level first, then it'll hit this level or this level, and that's the whole process. It's going to do that repeatedly. I'm assuming it's hanging around this level. So in this case, it looks like we would just have a bunch of losses, small losses, right? But objectively, I'd have a set of data that I can use to compare against the real-time results that I should see. So in the perfect world, if I were to buy here and sell for a loss here or sell for a profit here, every single time it touched this price point, I should have 1, 2, 3, 4, 5, 6, 7, 8. I'm just kidding. It didn't actually go to stop out here. But you'd have like a buy here and then a stop here. So was that like maybe 5 or 6 opportunities there? If my data, if I'm practicing this, doesn't match those 5 or 6 as close as I can get them, then there's some psychology at play that's kind of messing me up, because that's an inefficiency, right? And it's that specific gap between what you plan to do and what you actually do that is going to be what makes you a successful trader. You want to make that gap as small as possible. So if I say, I'm going to open my broker in the morning and I'm going to grab the whatever best ratio of volume to market cap ticker I see, maybe I use something like the MA to filter out stuff, which is moving average. I'll cover all the indicator stuff later. Let's just say that I want to take the first buy candle, the first bullish candle after 10 a.m., and then I want to buy the next candle, and I want to sell. So I want to buy the open, sell the close. I know that today, if I had done that, I would have a 1.33% profit on this stock. But that's my plan. So if my plan was to do that, and it's 12:30, and I'm over here and I still got those shares, and the price is down here at 260. And I was buying this up here at, let's say, where was that? Sorry, I lost my track there. Let's say this was my buy and this was my sell that I planned, but I'm still holding it and it's 12:30 right here. I've deviated. Something else happened because I didn't sell. I didn't take my profits. I didn't take my stop loss. I'd still be in that position for some reason. So something's getting in the way, right? So I need to look back and say, okay, what kinds of things was I experiencing when this closed? Was I willing to accept the small profit and just be done with it within that 2-minute period? Or did something else happen? Was there another thought in my head saying, well, what if, I think I can get more. I see that it's got, a wick at the bottom here. We're above the moving average. It's a pullback. I got a 5 candle rule. There's all kinds of justifications. We're in a fib right here. If I draw a fib, everyone's going to love that. We got a fair value gap right here. Like, there's so much stuff we can tell ourselves to make ourselves convinced that we're going to do whatever we want to do. It's confirmation bias. It's built into the human brain, and it's very powerful. So if you can't detect that and you can't interrupt that process, you're going to suffer from it over and over and over again. And that's what I'm here to help you break. But I don't want you to focus on, is this the perfect strategy? Is this the strategy? Do I buy on a break of every red candle range? Do I buy Haramis? Do I buy this moving average crossover, the RSI, the MACD, divergence, whatever? All that stuff is cool, but most people misuse it and 90% of traders fail. Okay. So if that's a cycle you want to break, you got to focus on why you can't execute before any strategy is going to help you. So just pick one that's dumb. Pick a simple, silly strategy that you can identify easily time after time after time. It doesn't matter what the end result is. Just practice it. Practice it 10 times in a row. Look at the data. Were you able to accept what you plan to do as the outcome that you saw? If this candle was red, if it started here and it ended down here, would you be able to accept that? Or in the moment, would you be fighting a bunch of demons like, it can come back up. This one had a wick. This one should have a wick. We're down here in a support zone. I see 2 wicks here. blah, 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 right? That's just what we do. We have to take that voice that compels us to just live in denial, and we got to shut it up because it wants to take our money. So before we get into any specific strategy and optimization and stuff, just like understand that I've been doing this for more than a decade and a half. Lee's been doing this for a very long time. Porter's been doing this very successfully for survival. Like, we all have our different approaches here, but the concept is the same. You have to do what you plan to do. Otherwise, you're going to have chaos. Okay. And chaos is inefficiency, and inefficiency is not what we want. So when it comes to, I'm going to pull up Miro here. When it comes to an actual portfolio structure, having that plan and knowing what we intend to do will allow us to know when we've deviated and when we didn't actually do what we meant to do. So let me close this little dialogue out. I just don't feel like paying for Miro anymore because I don't make any new flowcharts. So with all that said, I'm not going to go super deep in the paint on this one. Just understand that financial security outside the market is the number one factor determining your success in the market, because if you have to pull all your money out because you had some chaotic emergency and you didn't have insurance and you just weren't able to cover it, your trading journey is going to take a huge step back, right? Doesn't mean you can't still participate and you can't still, make all that money back, but you're going to have a much harder time than if you didn't hit that huge speed bump, right? So making sure you're financially secure outside, building a good credit score, all that good stuff, rolling to the point where you have a dedicated portion of your budget to make consistent contributions without impacting your lifestyle negatively, right? That's the goal. There should be a side hustle. That puts money into the portfolio on a consistent basis. And then here is where we get into the portfolio structuring. It's this first fork, right? So again, we want to put most of the money into something stable. We want to make sure that the money is protected above all else, right? And investments can go bad. That's all par for the course. I'll get into losses and all that stuff later, but we want to make sure that we're doing the best we can to at least protect what we can, okay? And let's say you're in Europe and you got to pay commissions and stuff. You're not going to want to do a whole bunch of speculation because those fees are going to eat you alive. They're going to eat up all your profits. And the big fear with that is that people that have commissions don't want to use smaller amounts for speculation because of the fees, but that's kind of holding them back because that smaller amount is going to outperform the larger amount, but you won't have to risk all that, all your savings basically to try to offset those fees. You can just keep contributing to this. And then when it's time, and you'll have so much more practice, right? You'll have better data. You'll have so much more practice. Then your speculation allocation will be bigger because it's a percentage. It's just an amount that keeps growing if you're able to make consistent contributions and you've got this passive income, you can reinvest, blah, 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 blah. Eventually you'll be able to outperform those fees and have a good time. But if you can't, you don't want to over allocate. You don't want to get chewed up, and you got taxes to consider on top of all that too. So the system's out to get you. It's your job to make sure you're protected, right? And that's what I'm here for. So when it comes to investments, there are many, many, many different forms. I just put dividends on here because that's the one I personally prefer, and it's the easiest one to teach because it doesn't involve like learning what options are or anything like that. But the swing and bull here, I'm going to put his link in the, I'll put that in here as well as on the chats. There's no pressure. I'm just putting these links in front of you guys in case you're interested in learning this stuff. I'm the lifetime coach. I'm way up on the other side. It's a bigger price commitment, so I don't typically encourage any new member to consider lifetime. I'd much rather see you guys go through one of the courses with the coaches because that's going to build those fundamental skills that we build on in lifetime. So if you don't want to do dividends, or if you've got maybe a different dollar amount, you can always do protective options. He does passive option strategies. He does the wheel. There's a calendar press. There's all kinds of stuff that you can do with options that doesn't involve just buying and selling naked contracts. Okay. So options are a great alternative to dividend positions. Ideally, you got some both in there. Some both is a phrase now. But either way, the main point here is that you want to protect most of your money and then put it into some form that's going to yield some result. And then you're going to reinvest those payouts that yield, right? Think of it like a flower, right? You plant a flower, you get 2 seeds back, right? You plant 2 seeds, you got 2 flowers, then you plant 4 seeds, right? And that's the idea. You just want to keep compounding because that compound growth is really what's going to skyrocket you into ridiculous numbers once you get a system in place. And I'm gonna specifically transition over to a small account focus here in a second. But once you've focused on protecting, contributing, growing, developing financial stability, and all that money is protected, you are practicing, ideally, right? Once it's time to consider real risk, then you can ease into a smaller a speculative allocation. And then you've got some mix in your portfolio of pretty conservative approach to money, and then you've got a more aggressive approach on a smaller portion, just in case something goes wrong, right? You can blow up this entire portion right here, and you still got your base savings, and that should be growing and yielding this payout, right? So kind of think of them as separate elements. But that's kind of the core of portfolio structuring. Now, within these investments, you might want to, do the sector rotation thing. You want to make sure that you're exposed to, precious metals versus oil versus healthcare versus finance sectors and all that other stuff. A small amount of burgeoning growth private companies, maybe some ETFs, maybe some foreign exposure. Like there's all kinds of different things that you want to incorporate, but not make it too chaotic. Like you don't want 50 tickers in a portfolio. I promise, it's chaos. So that's its own kind of branch on the tree. But again, for the sake of keeping this simple, let's focus on the smaller speculative allocation here, because again, this is what's going to outperform the growth of these investments. But this is a much larger bucket to hold a lot more so that they will eventually outperform the speculation stuff. And speculation is just when you're buying stuff based on, some fundamentals and some chart stuff, and then you want to buy it here and sell it here. Investments is something that you believe has a lot of growth potential and you want to hold it for a longer time. Not just based on the price movement in the chart over a couple of days or weeks, So when you're dealing with the speculation stuff, you don't want to marry any company. It's literally, you're just trading supply and demand. You're trading volume. You're just getting in and out. I got the 4 gets, you get in, you get yours, you get out, and then you get over it, right? If you find yourself holding a speculative trade because you really, really like the company and you believe they've got potential because of X, Y, and Z, you are not speculating, okay? You're kind of just holding and hoping that the market appreciates what you see, and that's not always going to happen. So you got to put a wall between those two, and that's going to help you out pretty significantly. So now, once we've got a basic structure in place and we make sure that most of our money is protected, and then there's a smaller amount here as like a gas tank, if you will, we got to fill that tank up. So how do we do that? We got to have some sort of nozzle in place. And that's going to boil down to the position strategies. So typically we want to determine how many maximum trades we want to take on any given day. You don't want to be sitting there for 4 hours grinding your butt off one share at a time. It's chaos. And remember, the goal of the market is to get in and get out. Just if you look at this portfolio right here, on this stock, it's a $125 account now. It's not a huge account. We just trimmed it back down to $100. And it's already up $26, like within, I think, like 6 days or something, 7 days. So it's not super difficult. Let me just pull up my pre-market here. So I don't even remember what ticker I traded. Was that DRMA? Yeah. All right. So this one, I just got in and out. I got in here and I got out there. That's all it was. I trimmed it as soon as it started to pull back right here. That's my only goal, is just go in, get like 1 to 1.5% for the day. You don't have to do that, but I'm just showing that that's what I do with this account for a very specific reason. But my goal is to take 2 trades per day. In this case, I took 1. I still have plenty of settled cash left over. I don't need to do anything crazy to improve that number. I don't need to be a hero, okay? Because I hit my goal, I can walk away for the day. And the real profit is the amount of free time you'll have when you're not sitting there for 4 hours staring at charts. So having a max number of trades per day and a goal will help keep you out of the market, because if it's just you and the market in the room, guess who's going to beat who up and take whose money? It's not going to end well. So having limits in place automatically helps, and it helps you keep your expectations realistic and achievable, because if your goal is to go in there and double your account every single day, that's not going to happen. I hate to say it. I wish you the best, but you're not going to do it. Not every day, right? So don't even try, because you're just setting yourself up for failure, right? But if you go in there with a goal to hit, a small achievable goal that you can consistently prove to yourself with the data that you've collected by practicing, that you can knock these out pretty easily and move on with your day. Even if it's swing trades, if you're swing trading, you're just looking at the market for a little bit of time. You're not staring at the chart on the 2-minute chart for 3 weeks while it figures out whether or not it wants to go up to your target. You're just finding the number of trades you want to commit to at a time, and then you're just obeying your rules, basically. So think of these like little EOD boxes, like a grenade explosion box, right? Like if the cops are told there's a bomb somewhere. They'll go into the little robot, stick it inside of a box. The bomb blows up. The explosion is contained in the box. So each trade is a little container, and you're potentially putting a grenade into every single one, because anything can happen. So you want to make sure that one grenade doesn't take out your whole thing, right? So that's why we want to break it up into multiple trades, but not too many, like 2, maybe 3 trades. That's solid. If your first trade hits, you don't have to take any subsequent trades because you've set that trade up to make sure that if you win that trade, you hit your daily goal, right? So that's it. Like we got to put a system in place. And then you got to figure out how many dollars you want to commit to each trade. And there's a couple different approaches you can take to that. Kind of the beginner one that we like to teach is the flat position structure. And that's just where basically if you've got some number of dollars, you want to split it up into some number of trades for the day. In this case, I used $1,000 in 10 trades using 10% of the portfolio per position. That's what we used to teach back in the day, but the market has kind of changed where that's going to be less efficient. Plus, I just don't want you guys committing that kind of time. And then taking those amounts in each of these little slots and then breaking them up into multiple buys, if and only if you want to average down, but you don't have to. I'll cover that in a minute here. But just figuring out how much money you want to put into each position and then figuring out if you want to take more than one buy, right? So if you know that ahead of time, you are in position to call out what you intend to do. And remember, that's the first part. The second part is actually doing it, okay? So if, in this example, we wanted to commit $20 to 5 trades, we would have a 1% max risk and a 2% profit on each of these trades, right? So predefined outcomes. And that would give us a finite combination of potential outcomes for the day. Now, you're going to have plus and minus because you're not going to get perfect fills. But you'll be roughly in this scenario here. And you can tell that 4 of these are net profitable and 2 of these are net negative. So you can't ignore losses. You can't avoid losses. The goal is just to make them small. So if we win 1 out of 3 trades, we'll be net negative by some small amount. If we win 2 or more, we'll be basically break even or positive. And then if we just win, half the trades, then we're net positive. So win rates are kind of a BS metric. So I'll explain why I'm kind of laughing at that here in a minute. But basically the idea here is that we've got some number of trades so that we're not committing a bunch of time. That gives us predefined outcomes. And then we use those predefined outcomes to put the profits or losses into one of 2 buckets. The first bucket is reinvestment, right? And we get that from these as well. So this is what really grows the account over time. The contributions get it started, then the reinvestments take over and it scales. And that's when the compound process gets insane. For losses, we can use those on our taxes. Again, this is just for U.S. advice. I can't use the word advice, but U.S. education. If you're overseas or if you're using a different broker, or you might be subject to different conditions, obviously you're going to know your circumstances better. Always talk to someone who's licensed and local. Don't trust a guy in Discord, right? I'm just giving you education, but you got to scrutinize it. And then your losses, again, if like I can use my capital losses, they deduct against my capital gains. So if, for example, if I cough, let's say a new trader makes $5,000 in a year, and let's say they lose $6,000, right? That trader is going to panic because they think they have to pay taxes on $5,000, but they've just lost $6,000, so they can't cover that, right? That's what most new traders think because they don't understand how the taxes work. In reality, what they've done is they've taken $6,000 worth of losses and they can claim those as a deduction against $5,000 worth of their profits, as long as there's no wash sales, which again, separate, unique circumstance. So they don't have to pay taxes on that $5,000 because it's offset. It's washed out because they took that number in losses. So they're net negative, which means they just don't pay taxes on their capital gains. So that takes a lot of the pressure off, knowing that most traders fail and that they lose money the first at least 2 years. Most of the time, you're not going to have to pay taxes on your capital gains until you figure out how to make profits that matter and outperform your losses. You're golden. Now, of course, again, you have to consider things like wash sales and other stuff, but I don't want to make this complicated. So just have a talk with your tax person at tax time and don't worry too much about your capital gains tax unless you're making obnoxious amounts and then not losing, which is a good problem to have. So that's kind of my engine in terms of, how I use my money in the market to function. It's a machine of function. So I put money in, and then that money makes more money. And then any inefficiency, anything that's kind of caught in a gap there, hits me back at tax time. Does that make sense? Doug, in order to claim capital loss on my laser, I'd have to admit it was a bad idea. Yeah, I know you're never going to do that. This is one of my friends. We play games together. You're gonna have that. Those shares are going to stay in your portfolio until you sell them. So lasers being bought out. So I don't know if there's going to be a dollar amount that you're going to get paid for those, or if that's going to go OTC, meaning that you can't sell it to a major exchange. In which case you would have to sell it on the OTC market, and you can still get your capital loss deduction at that point, but you have to be able to sell it. So if it's one of those tickers that like none of the OTC brokers are willing to sell, then you don't get that deduction. You know what I mean? But you and I have talked about that specifically. Yeah, so again, just to make it super simple, the goal here is to make sure that you're financially secure, making contributions, and that those contributions are being put to use. And they should be out there making more money. Your dollar bills should be going out into the wild and bringing friends home, right? And the ones that don't get recycled. They get brought right back in. And then at tax time, your bigger refund, because your deductions offset your burden. They're not credits, so you don't get them on top of stuff, but they're a deduction. That helps improve your tax return, which can then be used as an additional contribution, if it's positive, obviously. Pay your child support, guys. So with all that said, then the only things left are actually analyzing the companies, right? So, we can do fundamental analysis, which is where you look at the company's earnings. You look at their how much money they make, how much money they spend, what kind of obligations they have. I'll do a really quick overview on that. And then we also have technical analysis, which is where everyone kind of starts because of YouTube. And that's when you're looking at the actual patterns and identifying your risk and the potential. So before I get into the fundamental analysis, let me put Lee's coaching program in these chats because he is our equity coach and he focuses more on the due diligence portion. So I'll put that in there. Again, not a sales pitch. It's there if you want it. If you want to check out a coach, if you're going to lose more than $40 next month, it's worth checking out in my opinion, but there's no pressure, right? So fundamental analysis is just the study of a company and their ability to make extra money. So in order to do that, we got to understand a couple things, right? First, companies are just like us. Just like us. They have income, inflow, and they have outflow, which are expenses. I probably should have swapped those, but, but you get the idea. And hopefully you guys can see this. I know I'm kind of typing on a big monitor here. So, and all that means is that they have to do stuff. They have to pay rent on their buildings. They have to pay employees. They have to pay regulatory fees. They have to apply for licenses. And if, depending on the industry, they might have to pay for like studies and things like that. They have expenses. So the difference, and I'll keep this super simple, the difference between these two is their free cash flow, right? So a company that goes out and sells stuff to like in stores or on the internet, they sell stuff, that money that they get paid is revenue. That's just how much they make from sales. It's from customers. There's other forms of income. So I'm not going to go all into all those, but understand that revenue is different than their free cash flow. Okay. Free cash flow is the money that's left over when they're done paying all the stuff. So think of it, I like to explain this like a food truck. You know, if you open a food truck and you got to sell hot dogs, right? You got to pay for permits. You got to pay for your health license. You got to go out and buy ingredients, meaning the buns, the hot dogs, the sodas, whatever you got to do. Plus you got to fuel the vehicle, register it, all that good stuff. You got to pay insurance on it. Those are all expenses. So when you pull up to the park and you start selling hot dogs and the money that the customers are handing you, that's revenue. They're giving you cash and you're giving them stuff. Now, after all your expenses, the money that you go home with at the end of the day in your pocket, knowing that it's yours to keep, that's free cash flow. Okay. And that's what we want to see in a company because that's what's available to the market, you and I, speculators, investors alike, because that's where the shares have potential to increase in value. So companies can use their free cash flow to buy shares back as well, meaning that there's fewer shares available, which means that the fewer remaining shares are increased in value because, again, scarcity increases demand because of supply and demand. But we can't rely on that, right? We're just relying on, the rest of the market maybe seeing what we see and identifying low risk, high potential setups. But that's got to be based on something if you want to commit to something a little bit longer term than maybe a couple minutes, right? If you're just wanting to scalp, you're just wanting to get in and out really fast, like I do and some of the others do, that's okay. You're just trading a different type of thing. You're not trading the fundamentals of a company at that point. You're trading what's already baked in. And in this case, every single factor in the universe is baked into that price moving up and down in that case. So it's not going to matter whether or not a company filed something on time, unless a headline just pops up and panics everyone. It's really just about the spot volume, if that's all you're doing. But if you want to hold something for maybe a few days or overnight or for a couple of weeks, you don't want any surprises. And that's where fundamental analysis comes in. So we got to make sure that a company has good free cash flow. They should be increasing their sales, month over month, year over year, quarter after quarter. They should be making more money from customers by expanding their product lines and all that. Whatever their industry is, they should be doing better over time. We want to make sure they're reducing their outflow as well. It might increase, but proportionally it should decrease. It shouldn't be matching their inflow and growing, right? Because we want to make sure the company is able to widen that gap between the money they make and the money they have to spend, which again is free cash flow. So we want this number to go up as high as it can, as fast as it can. Okay. That's what makes us money in terms of share appreciation and market interest, right? Because that's what investors are looking for. And then, there's going to be, compliance issues. You got to look for compliance, make sure they file things on time, timely filings. They meet the exchange criteria. There's for example, a company has to maintain closes over $1 per share on most exchanges for some period of time. If they fail to close over $1, that's a minimum bid requirement. That's a specific rule. Then they'll get a notice from the exchange, and the exchange will say, hey, you don't meet our criteria. We're going to take your stuff off the shelf. And then they have to meet this criteria. So they can do things like splits, and they can modify the number of shares that are available to increase the value and get it back over $1. Or they can just buy their shares back if they've got extra cash. So understanding how much cash a company has versus how much they make versus how much they spend and how much they owe and what kinds of obligations they have, that's pretty important, because that's going to dictate where those headlines go in most cases. Now, at the end of the day, headlines just drive volume, right? The volume can still go in the completely opposite direction. Even if it's a good headline, the price can drop off. Like, things don't always make sense. And that is because your competitors in the market are robots. They're little algos. They don't care. They don't have emotions. They don't read these headlines. They just see a surge in volume and they want to exploit that. They see, okay, there's this number of this type of order on this side of the bid-ask spread, which I'll cover in a moment. Or there's this side here and there's a bunch of walls and they're configured like this. So I'm going to drive the price down because I want to get a better deal down here. And then I'll release the price back up to the upside. And then, if the volume's down here, we might have to pump some volume. So we'll do a little bit of micro transactions, some wash sales, get that volume surging back in. And then that'll compel other algos to jump in. And it just sets off this little chain reaction. And that's when things it gets very easy to live in denial. So like if you're listening to an earnings call and the price is just jumping up and down all over the place, and the earnings results come out and they're really good, and suddenly the stock is down 12%, that's just because of the algos. It's not the earnings themselves, in a lot of cases. So anyone who says they can predict earnings, I want to talk to them, because I'm going to look at the data and I'm going to call them a big fat liar. I probably won't body shame them, but I'll call them a liar, because that kind of statement is hurtful to people that are trying to figure out what works, So in the market, we want to make sure that a company is solid financially and that they're in compliance. And then we can look at the technical analysis part to determine the risk that we want to take within that overall big move that we're expecting. Or we can skip the fundamental analysis and trade on shorter time frames and just use straight up technical analysis to take low risk, high potential opportunities within the volume while it's there. If you're trading using technical analysis without fundamental analysis and there's no volume, you're guessing. Okay, so don't do that to yourself. You need volume for the price to move. So let's talk about what makes the price move, right? So remember the brokers, okay? The brokers submit the orders to the exchange. The exchange is then responsible for matching them and fulfilling those transactions. So someone walks away with cash, someone walks away with shares. Those are shown here. This is the order book. You probably can't see it that well on the screen. But this is where those orders sit, specifically limit orders, stop orders, and things that aren't market orders. Market orders are just filled as soon as they come in, as to the best of the exchange's ability, at the best price that's available. So if you see these not moving and you see this rolling and it's just going really fast, those are mostly market orders, or your broker's got a delay. But the bid price is the lowest. It's the lower of the two. There's the bid and the ask. So the ask is basically what the sellers are wanting to get for their shares. That's a higher price because they want to make more. So in this case, it's 243. The bid is what someone's willing to pay. Okay, so we don't want to pay a bunch. We want to pay as little as possible. So when we place buy orders that are below the price, they're going to sit on the bid, right? Because let's say I want to buy some at 242 right here. I would place a limit buy order because I want the price to come down here at or below my level so I can get my piece, and then it pulls back up. If we want to buy above where the current price is, we'd place it on the ask side, and then we'd probably get matched immediately because there's orders that are sitting here on the ask from sellers that want to get matched. So as soon as these come in on the ask, they get filled if they're buy orders in most cases. That's why they say, instead of market orders, just buy the ask, and that's just it's a efficiency thing. But you are kind of paying a higher price on that. So with that said, there is a huge misconception that most traders have, and again, I blame YouTube, that when the price moves up and down, that it's a result of some abnormal number of buyers versus some abnormal number of sellers. That is not how it works. What's really happening is that when these orders are sitting here, like on the ask at 243, those are either dominant or I want to say submissive, or lesser orders. And basically, they can be on both sides too. And that's how the price moves up and down. But basically, when a dominant order wants to get filled, or when it has priority by the exchange, it will reach across the bid and the ask, and it will try to find an equal and opposite fill, and then it'll pull the price up to match it once that transaction happens because it was the dominant side. So when you get a bunch of those firing off back to back to back, the price moves up if it's on the ask side. If it's on the bid side and they're reaching across to the ask and pulling those orders down to fill them, then the price will move down. Does that make sense? Oh, what's up, Wazy? How's it going, buddy? Are you in our Discord? I don't recognize that. I think I might recognize your name. But either way, glad you're here. Glad you're hanging out. Hopefully that makes sense, because that's one of the most common obstacles I run into when people are in a position and they're kind of trying to figure out what might happen. They say our buyer is going to come in and push the price up. And that's not an accurate statement at all. Like, it's just rooted in misunderstanding. And what is going to happen is the exchange will match orders on the bid or the ask. They can be buy or sell orders on both sides. And just think about it. Like, if I go to buy on the bid, I'm placing a limit buy order. If I want to place an order down here at 225, if I place a limit buy order, I'll get filled only when the price comes down here or below 250. Okay. If I want to place a stop loss down here, which is a sell order at 237, it sits there at 237. It's a sell order. I now have a buy and a sell order on the bid side because they're lower than the current price. If I want to do a buy stop order on the ask, it sits above the price because the buy stop order only gets filled when the price reaches or exceeds the trigger price, just like a limit sell order. So this is a buy order, this is a sell order. They're both above the current price, which means they'd be on the ask side. So it's not some abnormal number of buyers and sellers. It's just the order types. And that's why it's important to understand these first 6 pieces. And that's where most people get confused when they start. And then they try to figure out why strategies, are so inconsistent. So we can fix that pretty easily by just understanding how the exchange actually works. So let's look at technical analysis. Any strategy can be profitable if you use it the right way, as long as it accomplishes 3 things. Okay. And I always teach these. They're pretty straightforward concepts. First, the price needs to be moving in the direction that's going to make us money, right? We don't want to buy stuff that's moving against us because we're just throwing money at something that's already failing, right? That doesn't mean that it has to keep going or anything like that. It just means that if you see a series of red candles and you're trying to predict where you think the bottom is, you're trying to guess, you're going to fail a lot of the time. And those failures add up. So instead, if you like the move to the downside and you're waiting for a reversal, you can always just wait until it stops being red, right? Because if it's going to go up, it's going to go up anyway. And you could just catch that ride. You don't always have to catch the bottom. And in most cases, you're not going to catch the bottom. And if you think about it logically, most people that hold their runners try to predict the top. And most people that buy the bottoms or try to buy the bottoms and continue in drawdown, they try to predict the bottom. We suck at it as humans. I suck at it. So rather than trying to guess where you think a pivot might happen, it kind of makes more sense just to wait for the move to be happening before you jump in. And I like to use like a train as an analogy here. If you know that the price is likely to leave this area down here, and you know that it's likely to stop somewhere up here, you can view these as train stations and just get on the train when it's leaving the station, and you'll have an okay time most of the time. But what you don't want to do is jump in front of the train when it's screeching to a halt, and then you just hope you get it, because that's what happens. You buy it here, it goes down, you have the very bottom of this range right here drawn, you end up stopping out right there, and then it blasts to the upside. And you miss out and you feel bad because you tried to guess instead of following a system. And it's a cycle that repeats itself. And then before you know it, all your losses are big and traumatic. That's all your memory is. And then every trade you get into is going to make you flinch because you're going to expect it to go poorly, right? So we can fix that by just focusing on our skill set. We're not here to predict. We don't want to guess. The institutions you're trading against, those billion-dollar firms down on Wall Street and State Street in Manhattan, they're not guessing. They have this down to a science. A lot of the narrative around the market is also bogus. They've handed out this playbook that they want everyone to follow. They've taught people. Think about the guys that leave those firms and they go off and do these YouTube things, like the guy from Barclays, for example, with the footprint candles. They teach these strategies because they want people to follow them, because that's how they exploit you. So if I teach you about double bottoms and you're down here and you see this double bottom form, it's got a wide separated midsection. It doesn't have the best volume between the at the bases here, but you got a neckline here and you can trade that, right? There's some incentive for you to have this risk range right here, entry to stop loss, right? So guess what I'm going to do as a hedgie? I'm going to say, all right, I know everyone's going to buy here because I've given them the playbook and I've told them that they can get one up on the big guys, which is me, and they're going to buy there. So I'm going to accumulate some shares right here and short it back down. I want to absorb as much as I can because I'm accumulating down here below this zone. I want to make sure that I get my liquidity. So, for maybe here to here, I'm going to start soaking up as many shares as I can, but I got to discourage them first, right? I got to make sure that they don't feel good about staying in their position because I want to buy their shares. I need them to sell them to me. So what they do is they'll start to absorb right below a breakout level. And we see this all the time. And then sometimes they'll release them. Like in this case, it looks like it got released. They didn't do a whole bunch of absorption. Now this is also super low volume. But what they'll do is they'll induce people. That was probably a bad example for the end result there, but you get the idea. They induce people to follow these patterns, and the patterns are valid in a lot of cases, but they're not for predicting, right? Use them for analysis. And then we could say, all right, well, I've got a double bottom right here. It's currently forming. I know I've got a neckline up here. Now this is more of a head and shoulder setup, right? So let's do that. Let's do the head and shoulder setup. So I've got a shoulder there. I've got a neckline here. So the theory is here to the downside, we should come down here and hit that bottom, right? That's just a very basic, and more specifically, just to draw it out, what it looks like. That's what they'd be looking for. That's what the playbook says to do. And, we've got a fair value gap here and it validated, and we've got compression candles, we've got haramis, we've got all this stuff, right? We got all these things that we can use to convince ourselves that we're going to be right. But ultimately that doesn't matter, right? We're not here to be right. We're here to be safe, and we're here to make money. And this is where most people tend to hurt themselves. So I'm trying to find a good example that's moving. It'd be pretty nice if I could, but everything's kind of crummy right now because the holiday. Anyway, all right. So let's say you want to trade. I don't really have a good example here. Let's say you want to trade this one, hi-ho, right? This one has gone range to range already. We plotted that out previously. Let's say now that you are able to justify to yourself that you believe this stock will leave this orange box and come up here to this white line up here, and that you're going to be right? You're not going to be wrong because you see the setup. You've done this 1,000 times. You see some guy on YouTube saying it's going to happen. You got every reason to be high conviction in this trade, right? All the boxes are checked. And then what happens? The price comes down here, right? This moment specifically, when it breaks out of the bottom of that box, that is where you study. That's where, things don't go as expected. And I'm going to talk a little bit about neuropsych here. So as humans, we are reactive processors. Okay. And we get stressed out when there's uncertainty. It doesn't matter if it's a relationship. It doesn't matter if we get lost driving somewhere, or GPS craps out, power goes out, your phone's about to die. Like, it doesn't matter. If there's a problem we can't solve, if there's stress that we can't resolve, we tend to stress out, right? And that works because, again, I'm not trying to make this super complicated, but there's three parts of your brain that are involved here. There's the hippocampus, the amygdala, and the anterior cingulate cortex, which is the ACC. So basically, and I'm going to keep it super basic, your hippocampus is this big library of memories. It just gets input and says, hey, what do you got for this? What kind of memories do we have about this particular thing? And it returns as whatever it can. Okay. And then it loads it into the anterior cingulate cortex, and it also sends a signal over to the amygdala. It says, hey, buddy, what kind of emotions do you remember about this? And then the amygdala is like, here's what I got. So it all gets shoved into the ACC. The ACC has this expectation that's been formed about what we should experience. And then when the data that comes in to compare against that expectation doesn't match, we get panic, right? It throws a little panic signal everywhere, throws it right back to the amygdala. The amygdala flares up. It wants to be like the Hulk, and it wants to protect us. So it shuts everything else down. It's like, guys, I got this. We're going to use violence. We're going to use impulse. And before you know it, this stock is down here, and we have hesitated because that's the other type of response that we can get. And we don't know what to do. We're stressing out, and we're convincing ourselves all along the way that this is going to reverse, and it goes down even further, right? And then rather than taking the loss, right? Because remember, if your plan was just to trade it here to here and to stop out right here, and you're still in it down here, you haven't done what you said you were going to do. And that's where you need to study. If you told yourself ahead of time, I like it here, but I'm willing to add it down to here, and you're okay doing that, that's okay in some cases. You don't want to average down every position. Like if it's a quality company and all that good stuff, and you can justify it, or you like the volume and you see value down there at those levels, that's a different story. You're absolutely free to make those decisions. But if your plan was to add here, and then stop out if it breaks below this box, and you're still in it, and now it's down at this box, right? You've still deviated. So it's the same end result. It's just how much pain do you want to endure, right? So we need to figure all that out ahead of time, and we can only really do that by studying ourselves in the moment that happens. And we can only do that once we have a specific comparison to put in place. So you got to set up a benchmark. Say, this was my plan for the day. I wanted to take no more than 3 trades. I wanted to use no more than $100 per trade. I wanted to trade this specific strategy using this specific area and this specific candle pattern, or whatever your criteria is. And then I saw this, I saw this, I saw this, I pushed this button, this happened, I had this reaction. I didn't push the button when I was supposed to. There was a deviation. That's the value. That's the data that you can study. So in this case, and this is an important concept, in this case where you've managed to just completely abandon your plan and you're taking a huge loss right here, you are paying the market a cost. Right? You pay a cost anyway. If you stop out here, it's a smaller cost, but you still pay something. But if you're down here and the price is hemorrhaging and you're just losing, and you're getting stressed out, you're getting data. Okay. And that's the data that's going to accelerate your trading going forward, because you're able to take that data, that cost, and assign a value to it. And that's our ability as traders. That's our superpower, because most traders can't do that. They just say, oh, I paid a huge cost. And then they feel bad and they beat themselves up because they want to do better. Okay, so first we need the portfolio structure. Sorry, I keep going to the wrong window here. We need the portfolio structure first, all right? Once we have that in place, then we can focus on investments. Once the investments are in place, then we can focus on the speculative stuff. We know how many trades we want to take. We know how many dollars we want to take. We know the outcomes we should experience. So we need to focus on this little machine here that splits those dollars up and turns them into this right here, these two end results. And this is where it's going to get interesting, okay? So regardless of what your strategy is, I'm going to erase all these lines. I don't care about them. Regardless of what your strategy is, you need some sort of control, right? You need to say, this is where I want to enter based on a specific reason. This is where I want to exit for a loss. This is where I want to exit for a larger profit. Okay. So going back to those three things that any strategy must do, or should do, in my opinion, it should tell you to get in when the price is moving in the direction that makes you money. It should get you out when it stops doing that. And it should keep you in as long as it continues to do so. Okay. Those are the only three things you need to do. So in this case, if you want to trade a break over every red candle of a certain size or smaller, let me get off this time frame because it's trash. And you see one red candle here, one red candle here, one here, one here, one here, and none of these have a candle that breaks over, but you somehow entered here, you have broken your plan. That's a deviation. That's worth writing down and studying. And that's where you got to spend your focus. It's not on the strategy itself, because that's very easy to tell. All these candles had lower highs, so you didn't have anything break over, so there was no reason to enter, okay? But you did. It doesn't mean you're defective. It just means that something made you do that. And you can still hold yourself accountable without the blame, because at the end of the day, you're just a little reactive processor. It's part of your brain just compelled you to do that. The best you can do is the best you can do, even if it's not your best. So we just got to figure out what's making that happen so we can work around it, right? So no harm, no foul. You're just going to be a little frustrated, and maybe it's a little crummy taking losses, but you get that money back at tax time. Again, tax advantage. You just got to make sure they're controlled. And that's why we break things up into positions and maximum numbers of trades, and we have stop losses and all that good stuff. So I'm going to teach you guys a very, very simple strategy. I teach on all my morning streams here. Let me just find a good ticker. I'll go back to the 1 day here. Let me just see if I can find something. All right. So basically the strategy is very simple. I just, and you guys all know, I keep it very simple. I just go to my pre-market top gainers and losers. I make sure it's on top gainers. I sort it by percent change. I look for the volume to be larger than the market cap. And I'm not going to explain why on this stream. It's on all my streams. But I like that first. And this is usually at like 9:20, 9:25 in the morning. I'm just building a little watch list, and then I just go through each one, and I just establish ranges where the price has historical violence. So I want to see where the price blasted out of, and then I want that range to be as small as possible. So in this case, we got a nice, beautiful pop on the 2-minute time frame on NWG, but it's a pretty sizable range, So I can look back and I can say, okay, well, did the price? I'm not looking over here because we wouldn't have access to that information yet. Did the price show anything here before? Like, is it a good, reliable level? And yeah, it kind of caught the price a bunch, and then it had that massive move up, but it's kind of a sketchy level. Like it's a bigger range. So maybe we'll keep it on there, but I think we can find a better range, right? So then we come back over here. I've got one right here. It's okay, but it's still kind of a big range. And then we see this guy right here. This is super tiny. That is what I love to see. That's my bread and butter right there, because I want the risk range to be super tiny. So if I catch a break off that level in the future, I don't want it coming back down. And if it does, I don't want to be in it very long, right? Because remember those 3 criteria: get in when the price is going up, stay in when it continues to do so, and then just get out when it stops doing it, right? That's the whole point. It doesn't matter if you're in the daily time frame, the weekly time frame, the 5-minute time frame. It doesn't matter. So now, let's say that these are the only levels I drew for the day, and I drew this one down here as well. I think I was on a different time frame. I think I was on the 5-minute or something. But either way, let's say these are the only levels I draw. I'm only looking for one opportunity here, one opportunity here, one opportunity here, right? I've got 3 zones that I can trade between. So I'm just looking to trade the gaps, and I don't need to trade the full gap. Okay. And I'll get into that here in a second. So let's say now it's 9:30, blah, 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 blah. Market opens. We're well above my range here. I don't see any other areas up here. Maybe this guy right here, because it kind of leads into that move there. But I don't really like that. So let's say I'm just waiting for the price to come down here and test my zone. Okay. So price came up here, rejected off this guy. So that zone has some validity to it. But again, I don't really trust it. So boom, price shoots down into here. Now I can start looking for entry opportunities if I want, right? Now, again, I didn't really like this top zone. It's okay, but it's a pretty wide risk range. So let's see what it gives us. And it's perfectly okay to just let stuff go. You don't have to trade stuff. So in this case, it looks like it just would have sold off even harder. You have no way to know that. You don't have any access to this information until that candle actually forms. So So everything we do, it has to be hindsight. It has to be reactive. So we have to prepare ourselves so that our default response isn't panic, because that's what messes us up. So our plan was to sit this one out because we didn't like the range on that candle. All right, so then we had this zone down here and we've got one below it. So let's see if the price reaches those. So the price kind of hang out in this one, but it didn't reach the one that I'm looking for. So again, I'll just let it go, right? There's no harm in just letting stuff go. So right here, we come down and we tap this level. That's what I like. So now I'm just looking for the price to move out of that train station. I want it to go from Florida up to New Jersey, right? I want it to go. So in this case, I'm just looking for a move up. And it looks like we got it, right? So you can use the specific candles like color changes. I do one where as soon as the price breaches a level, I got to zoom in a little bit. As soon as it punches through the level, I just put a zone, a level right there. I'm going to erase this big one here because it's kind of confusing. This candle basically punctured this. It popped the balloon, if you will. So I draw a line over that candle, and then when the price breaks out, that's where I put my entry, and the stop loss is below the box, basically, or below the entry candle. So in this case, our stop loss would be like right here. So maybe we would have stopped out here. It's kind of hard to say. Either way, we can always just get back in, right? And that's why we take maybe 1 to 3 trades per day. And in this case, we would have popped up pretty nicely and got a big fat profit on that. But we don't know this is going to be the top either, right? We got lines drawn. That's cool. But this is where it gets fun, right? Because this is where most traders are like, oh, this isn't going to make money. But if you took an entry and you had defined risk and you had a disproportionately larger profit, say 1 to 2 ratio, you don't need to catch the entire move. You know, you can catch most of your profits. And that's what I did today. I just took most of my profits at a nice, consistent profit level. So like, let's say we get in here, 1 to 1.5% profit is right there. You can get that so many times off most price moves in the market, especially in these lower float fast movers anyway. There's almost always going to be 1 to 1.5% profit. So if we lock in at least most of our shares on that smaller move, just to guarantee a net profit, the smaller piece can run over a wider distance and make even more profit, but we don't have to allow it to go down. And that's the cool part. So, and that's where people just like traders tend to tune out and they're like, oh, you're never going to make money off of that. And that's not true. The fact is those small consistent base hits over a frequency add up stupidly fast. It just takes consistency. And then you can't have big losses in the mix. Otherwise, you're just going to set back a bunch of them at a time. But it absolutely works. It's a tortoise versus the hare situation. I love being the tortoise because I don't mind not putting a bunch of effort into the market. So in this case, the price came back down here and then it immediately shot back up to this one. So the price likes going zone to zone. All I have to do is catch my piece. So if I got in on this candle here, I could have sold a piece of it right here on this guy. Right as this was taken off, or right here before market close, and then we'd have had a runner left if we wanted to keep any after hours. And that's it. Like, it's a very straightforward strategy, but it doesn't have to be complicated. If your strategy instead, let's just erase all these lines. If it was to use the 20-period moving average and just catch a small red candle and then a color change off the positive slope moving average, let's see if I can find an example of that, or if this one just went down. So this is the size candle that I like, but the moving average slope is negative. So that wouldn't have been an entry on that one. Let's see. We got a kind of a small one here, but it's pretty far away and the price never broke over it. So not an entry. Looks like this one just wanted to go down. Yeah, right here. Okay, so we've got a small red candle. This is after hours, obviously. We got a small red candle here. The price did break over it. That's my risk range right there. Profit range is up here somewhere, disproportionately larger. And I get my 1.5%. That's it. I just be done with it. It doesn't have to be huge ranges that have these miraculous pops and you catch it at the perfect moment and then the price continues for 20 minutes. That's a lot of work. I don't like doing all that. It doesn't matter what your strategy is, just do it consistently and you'll be okay most of the time. And if you're not, that's just a matter of fine-tuning the strategy a little bit to make sure it's doing those 3 things. Getting in when price is going in your direction, keeping you in when it continues in that direction, and getting you out when it stops. Okay? So now, and again, when you're new, I just want you guys practicing. I don't want you to feel like you have to risk real money. So now we got to talk a little bit about psychology. Okay. And this is, I think, where I've seen the most progress, I think, with my students, is that you have to be able to take the pressure off yourself. And the way to do that is through understanding that the market is a machine of circumstance. It's not consequence until you get involved, right? And then even then, you still have circumstance on your side, okay? So when it comes to any price point, let me just erase all these. I'm just going to just randomly click right there, 47.84. When it comes to this specific price point, okay, which we used a super complicated method to determine, I just moved my mouse like this. The price will always ever move above it, below it, or sideways every time it hits this price point, right? It can only logically do one of those three things every time it touches it. So knowing that gives us power, because we can also determine an action level down here, and we can determine an action level up here. So if the price hits this level, we can choose to buy. If the price hits this level, we can choose to sell. If the price hits this level, we can do the same exact thing and sell. We're taking risk on, and then we're being risk off at this level and this level. So it doesn't matter which one gets hit first. That's just the same action. It's just exiting. Okay. It just happens to be over a shorter range or a larger range. And in this case, let's assume they're the same. Okay. Let's move them to the same range. Let's say the price hits here. It happened to go down and hit this one, right? From this specific entry point, the price was here. Sorry. Price was here. It happened to move down, right? The price just went down from that level, and that's all we need. And then the next time it hit the level here, the price went up. And then let's see if it hit that level again. The price went here. Let's see if it goes up or down. The price went up. Okay. The price hit the level here. Let's see if it goes up or down. It went down. The price hit here again when it came back up to close that candle, and then it went to the upside. So it doesn't, we're just collecting data. Okay. We're not forcing our will in the market. We're just saying, if the price hits this point, we push this button. If the price hits this point, we push that button, and that button if it hits that level. Okay. So what we can assume is that when the price is here in this moment, before we see the future data, because we don't have access to the next candle, we have to understand that there is a concept there's a level of duality, right? That when we put our money into this, I like to use like a coin jar. We put our money into this magic jar, okay? And that money is simultaneously a profit and a loss, okay? So we put a quarter into a jar. We're pulling out another quarter in the future that's heads or tails. But while it's in the jar, it's both, right? And it's very easy to say it's neither one. And we can do like a Schrodinger's cat situation. But in reality, that money is both, because it's affecting you. You're having thoughts about it. You have to focus on it. There's emotions attached to it. It's real money. It doesn't stop being money just because it's in a trade, okay? So it's very real. And this concept is very popular in quantum physics. It's called superposition, or decoherence is specifically the fall off of that. So, and think about that like a particle being in two states at the same time. It's a little bit complicated, so I'll keep it simple. But basically just think of it like, you put a quarter into a jar, it becomes heads and tails at the same time, okay? Over time, it's a magic jar, so let's seal it. Let's keep the air out. Over time, when it's time to open the jar and pull that quarter out, it'll solidify into a heads or a tails. Does that make sense? Like it can only be one or the other when we actually pull it out. When we lock in that reality, it's going to be a heads or tails. It's going to be a profit or a loss. And we can't have both at the same time when we take that money back. Okay. So if we, let's say we open the jar early, we interfere, we let the air in, we're going to lock in one of those positions prematurely. And it's going to become a heads or a tails, but it'll be kind of malformed. It's not the heads or tails we expected. And that concept is called decoherence. That means that we've allowed interference, basically. It's an environmental decay thing. But for the sake of this, we're taking that quarter, we're putting it in the magic jar, we're closing the jar, we're sealing it, and then we're just busting it open early to get that quarter back, and then we don't really know what we have. Maybe we pull out a shoe, right, because we interfered. Maybe it's an old license plate. So if we let when we let the coin determine when it's time to open the jar, and we open the jar, we'll pull out a perfect heads or tails. Okay, that's the main point that I'm driving at. Now, our goal is to take, let's say every time we put a coin in, we take a coin out. If it's heads, we can take out 2 coins. If it's tails, we still just pull 1 coin out. Does that make sense? That's why we want to have a disproportionate risk-reward ratio, because when we win, we want to get rewarded. We want to increase our value because all the probability that we have put into this skews our probability to the upside of us having a profitable outcome. So there's still going to be losses, and all we have to do is control them, but we have to also allow for profits. Does that make sense as a concept? And that is the nature of trading supply and demand. It doesn't matter if you're investing in something at, you buy a startup company at $4 a share and it goes up to $600 a share over the course of 15 years. It doesn't matter. You're still doing the same thing. You're buying something with the intention of leaving it sealed in a jar until the chart or the circumstances tell you to open the jar. If you interfere early, like that guy who paid for a pizza with was it like 10,000 Bitcoin back in the day, he lost all that. The coin was not worth the value that it should have been because he interfered. He disrupted the process early. It wasn't done cooking. But it is what it is. He got a pizza out of it. So instead of pulling out more Bitcoins, he pulled out a pizza. So in the market, it's the same thing. We just have a plan and then we have to do it. Okay. And that is how we get to these finite, this array of outcomes here. And that's how we get consistency. So that determines your trajectory. If you have, let me pull up this, this is my favorite part, I think, for members, because then they start to see the good stuff. So let me just duplicate some tabs here and I'll pull them over. Duplicate. All right. So in this case, I've got a spreadsheet that I was using to track this small account. On this account, we started with $100 or $30. I'm sorry, $36.48 on November 1st. With a contribution rate of $200 per month that I'd be adding in, right, according to this. I didn't do the investment side on this account. I was just doing speculation to show the compound growth. But I was making consistent contributions, and we were using a finite number of trades per day, set number of dollars per trade, finite outcomes, right? So in this account, we started at 236.48, and then within we had a little hiccup there with Webull. They didn't fill one of my orders. It was a little messy, but they ended up reimbursing, so that was good. But that did bring the account value down like $80 or something, and then it was restored later. But yeah, we got that account up to, where was it? I think it was this one right here. I think it was this week on December 5th. So the start of this month, we had it up to 518.75. So if we look over here on this tab, oh, no, it's the wrong. Okay, it's this one here. Sorry. You can see the consistency in the P&L. Now I had some bigger losses in there. I took some drawdown and we had that little Webull glitch there, which was restored again, thankfully. But you can see it's relatively consistent, right? Minus the chaos, right? But we still made a decent enough amount on the dollars invested on that small portfolio. We started at $30, we got up to $500. Now we contributed some. We contributed $430 to it, so that's the bulk of it. But we still managed to make a pretty decent ROI on that $430 that we contributed. So I got the percentages wrong on that. 88.75 divided by 430. So we're up 20.64% ROI within, basically a month, because we started November 1st and we kind of reset the account on December 5th. So within a month, we were up about 20%. Now, I'm also doing this small account again. So I've reduced the account because a good friend of mine had to take their money out for like Christmas and stuff, and I didn't want them to be left alone, right? So it's a good opportunity for me to just trim this down again. So last week, I think last week, 15th, the week prior, sorry, I reset this one back down to $100, and including a $16 hit. So I lost 12% one day. I had drawdown that I allowed. I ended up taking a step away, and that just worked against me, and I ended up just locking in a 12% loss. That's okay. Even with that included, we're up about 26% in just over a week, just locking in small, consistent gains. And then this one here on the 18th had a pretty good run. It was just one that just kept going, and we let it breathe because we don't want to choke everything out necessarily. But that's it. It's some days I take very small percent profits. Some days I take decent profits. But most of the time, I just shoot for this little 1.5%. If I was just trading by myself and I wasn't live streaming and stuff, like I call this out on the streams most days, when I hit that 1.5 to 2%, I say like right here is where I would just walk away if I was a new trader. And that's as complicated as it has to be. Because again, I don't want to commit a bunch of time to the market. It's not a lifestyle. Okay. So with all that said, I don't want to hear people think that they need a huge amount of money to make money in the market. Now, $26 is not life-changing, but 25.99% scales up nicely if you're getting 1 to 3% or whatever over so many number of weeks, right? So the goal for this account, if I go back to this tab here, ignore this $3 million. That is not realistic, but it puts us in the ballpark, right? Because you're going to have days where you just lose and stuff like that. So if we had followed, and I didn't trim this account down, just 1.5% per day with a $36 seed and a contribution rate of $200, assuming I hit my goal every day, that portfolio would be at like $1,000 in, next month it'd be like, where's January 1st? Sorry. It'd be $900 basically next week on New Year's. And let's kick it up to like April 26th. That's my birthday. We'd be at like $4,000, right? And then by next July, next July, $9,500, $10K a week after, and then $20K 2 months after, $50K in December. So this time next year, we'd be about $62K. Like it compounds very quickly once you get over a certain point. But the goal isn't to chase big profits. These are just 1.5% profits every day, right? Some days you're going to have more, some days you're going to have less, some days you'll take little losses. But the goal is to just minimize the losses because that's what takes people out of the market. And then it's just up to you, basically, when you take profits, and that becomes the challenge. How much profit do you need? And when is good enough for you to just close it down and walk away for the day? And that's where people get stuck because this becomes an addiction. The market is sitting there in the room with you and you see all these big dollars and you start thinking about what you can do with all that money. And before you know it, you're down and it's not coming back, right? So to break that cycle, we have to determine a cut point in both directions. And we have to just get back to our jar and say, okay, I have my action level where I want to get in. I have an action level where I want to get out to the upside and an action level for the downside. They do the same thing. They get the risk off the table. I either walk away with a small loss or a disproportionately larger profit. Okay. Anything that happens after I'm out, I don't care. I don't have access to that information. Right. And you guys see that in the morning. I say, we're going to look at a different ticker because I don't know what's going to happen in the future. I make the decision in the moment based on what I see in the moment. And like this morning with the RMA, I traded that one and I didn't like what it was doing and it happened to continue going down, so am I going to jump for joy and say, yeah, I managed the hell out of that risk and I made the right call, blah, 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 blah. No, but I'm also not going to go over to another stock that happens to run for the day and praise myself for being in it and then beat myself up because I got out too early, quote unquote, right? But our brains are upside down. We don't praise ourselves for getting out too early when it's a loss. We should. I love getting out early. But we always beat ourselves up when we get out too early on a win. So I'm telling you, it's all just a psychology thing. I know I'm kind of rambling a little bit, but I want everyone here to understand that this is not you're not trading to be right. You're trading to make money. You have to have a system. You have to have a level of self-awareness, and you have to develop that. You can't just expect someone to tell you to, look for this pattern and place your buy here and place your sell here, and everything's going to be perfect. You can't do that. Just like you can't expect someone else to tell you to buy stuff at a store and then hope your budget is fixed. That's not how it works. You have to put in the effort and build the foundation, and you have to have rules in place that make sense, and they have to be based on your psychology because that's your number one determining factor for whether or not you're actually going to be able to follow it. So some people might like the short-term scalps, the extra time and all that. Some people might prefer to just look at higher quality stocks, and that's okay too. There's no wrong answer, but you don't want to mix the realms. And that's where people, again, they just get messed up. Like if this stock right here, MWG, it's a 40-cent stock. If you wanted to invest in this company because you saw a big move and you didn't look at fundamentals, you'd have a hard time because it's going to hurt you. There's no justification for the stock to be, up here at 60 cents today, in my opinion, other than just pure volume. It's a volume play. It's not a fundamental play. It's not a growth stock, at least not from what I see. It just happens to get a headline that compels these algos to take advantage. And you could see this one here as the next setup. I'm going to watch this one tomorrow morning. but I'm not going to buy it today and hope that it goes up. I'm going to, well, not tomorrow morning, Friday morning, because I see there's an algo sitting on this and I recognize the type of algo because I've been in the market long enough. I know what this is looking for. So I can look for the same things. If I see it, I'll wait for this algo to say, hey, it's the green light. I'll place my buy and I'll get the hell out. I don't want to be in here for, for any extended period of time because I value my time. And I know that my time is better spent outside the market. And I also know that these numbers compound stupidly well. And that's my goal. My goal is to, sorry, I don't know why that's hanging out there. My goal is to compound these over time, over and over and over and over and over again, and just pick up my little grains of sand and build my beach, and a year from now, there's going to be thousands of traders that are just going to be like, man, the market sucks. I'll never figure it out. And they're going to ask for strategies. They're still going to be watching YouTube videos. They're still going to be trying to, master the next strategy and see what works and all that good stuff. And I'm just going to be chilling, like doing the same thing I do. I've been doing this for a decade and a half. I'm telling you guys, consistency beats luck every single time. You cannot predict the market. Anyone who says they can is lying, and they have an interest in lying to you. So I don't want you guys to be lied to, and I don't want you to believe the lies. And there's other lies that I also don't want you to believe, and that is like the simple things, like how price actually moves. It's not different size audiences or any of that stuff. So I've definitely rambled, and I'm going to cut this one off here. But I'm glad you guys were able to hang out, and I hope you guys are enjoying of your holiday. I don't want you to think about the stock market at all. Go spend time with your loved ones if you can. If you can't, that's okay too. I hope you have a good enough day as possible. If you have to work, I get it. That sucks. I used to volunteer on the holidays so that people could have the day off with their families. So just do what you got to do. We'll be here on Friday. I'll check in tomorrow as much as I can. I'm glad you guys are all here today. I know it's Christmas Eve, so go finish your shopping because I know 90% of you guys aren't done shopping or wrapping yet. Let me end the live stream portion of this. I'll be in the Discord here as I ramble some more.